Good afternoon and welcome back to the Smarter Wealth channel. I am your host, Troy Lerche, bringing you an update for the week ending June 11th, 2021. I am coming to you live from the beautiful Fleming Island conference room and hope to start having some clients come in and have in-person meetings as things get back to normal. As we dive into our indicators, the CAPE indicator went even higher last week, up to 37.67. And then we remain in cyclical bull territory. All four indicators are also in the green. And as Rick said previously, we're green across the board. So we are deploying new cash and getting the portfolios all in the market as we see fit. In the US markets, a sharp decrease in the long-term bond yields appeared to help push the S&P 500 to a record high in a light trading week. And if you haven't heard, a lot of times you'll hear the saying, sell in May and go away. Sometimes there's a lot of people on vacation and stuff, so trading volumes can drop significantly over the summer months. The tech-heavy NASDAQ composite index outperformed, rising 1.8%, marking its fourth consecutive weekly gain, while the narrowly focused Dow Jones recorded a modest loss of 0.8%. By market cap, large cap rose 0.4%, mid cap S&P 400 was up 0.9%, and small cap Russell 2000 finished up 2.2% for the week. In international markets, emerging market asset class was down 0.8%, while international developed markets added 0.5%. In commodities, precious metals finished the week mixed, while gold retreated 0.7% and silver rose 0.9%. And crude oil continued its breakout to the upside, rising for the third consecutive week. West Texas Intermediate crude oil finished up the week 1.9% to 70.91 per barrel. In US economic news, the number of job openings rose to a record high, but employers say they can't find enough workers to fill them. The Labor Department reported job openings soared 9.3 million in April from a revised 8.3 million in the prior month. Many companies, both big and small, are reported having difficulty finding qualified workers. And this is tied to what we talked about previously, which was getting people back to work with problems that early retirement, lack of childcare, and lingering fields of the coronavirus and generous unemployment, which should be interesting because some unemployment benefits are coming to an end very soon. To add fuel to the fire, a record number of people are quitting their jobs. Nearly 4 million people quit in April, double the number from the same time last year. And this is the so-called quits rate, rose a tick to a record 2.8% among private sector employees. And this quits rate is rumored to be the Federal Reserve's preferred gauge of the health of the labor market, as it assumed that an employee would only quit in favor of a new job or a more lucrative one. At the height of the coronavirus crisis, the quits rate had fallen to a 7-year low of 1.8%. Small business owners reported labor shortage across the nation while holding back growth. The National Federation of Independent Businesses stated its small business index fell for the first time this year over growing labor and inflation worries. The index slipped 0.2% to 99.6, and business owners are saying they're losing sales because they can't find people to fill open jobs. And now, as we've talked about each week, rising inflation are adding to their worries, as the nation's largest small business lobbying group said a record 48% of small businesses surveyed could not fill open jobs, even with many of them offering higher pay. Cost of living surged again last month as the pace of inflation soared to a 13-year high of 5%, reflecting the broad increased prices across the US economy. The CPI, or Consumer Price Index, jumped 0.6%, last month, marking the fourth large gain in a row. As the government reported. Economists expected a gain of 0.5%, so not too far off from what they expected, but the rate of inflation over the past year has escalated to 5% from 4.2% in the prior month. That's the highest level since 2008, when a barrel of oil hit $150. So the Federal Reserve insists that price pressures will subside once the US and global economies reach a more normal footing. The upsurge in inflation is mostly tied to the temporary shortage that'll fade away as supplies catch up on demand. In international economic news, with Canada's COVID-19 vaccine rollout underway, Canadians start to look forward to their world returning to normal. The Conference Board of Canada is forecasting 6.1% increase in real GDP in 2021 and a further increase of 3.5% in 2022. Across the Atlantic, the United Kingdom Office of National Statistics reported the UK economy grew by 2.3% in April as the easing COVID-19 lockdown measures fueled a rebound in consumer spending. Germany's central bank reported it was raising its growth and inflation forecast this year and the next, assuming the cases of the coronavirus continue to wane. The bank also raised its forecast for inflation this year and next, warning that it's still, quote unquote, upside risks. It saw now inflation at 2.6 this year, which would be the highest since 2008 as well, and well above European Central Bank's target of price growth, below but close to 2%. In Asia, clients talk economic partners have paused their attempts to reduce carbon emissions as spurring economic growth once again becomes a primary focus. Officials at China's main economic planning agency, the National Development and Reform Commission, have limited the initial scope of the national carbon trading system, which is set to go into full operation later this month. As the world's largest carbon emitter, China's actions are being closely watched by the rest of the world. China's president has said China will reach the peak of its carbon dioxide emissions before 2030, but he hasn't elaborated on how the country will achieve this goal. Finally, as Rick mentioned earlier, record prices for used cars and trucks were the biggest contributor to inflation last month. According to the government's Consumer Price Index report, prices for used vehicles surged 7.3% last month, following an even bigger 10% gain in April. Why are prices of used vehicles skyrocketing? In short, there are more people buying cars than there are cars in the market. That's a standard, typical supply and demand issue. New cars, trade-ins are usually the biggest source of used cars, but supply chain disruptions, especially a widespread of specialty semiconductors used in the auto manufacturing, have limited availability of new vehicles, causing prices of scarce used vehicles to catapult even higher. Well, that's all for today. Again, coming from Fleming Island Conference Room, wishing you a great week, and we'll talk to you soon. Bye.